I'm Seema Modi, filling in for Bob Pisani, and it is the final trading day of the month, and markets continue to tread water amid debt ceiling drama in Washington, global recessionary fears, and interest rate uncertainty. But there's plenty of movement below the surface. All month long, bonds have looked like the best game in town, with fixed income ETFs enjoying massive inflows. And non-U.S. equity ETFs have seen stunning outperformance over the U.S. What's the market set up for June? Joining me now is Dave Mazza, Chief Strategy Officer at Round Hill Investments, John Davi, CIO of Astoria Portfolio Advisors. Great to see you both. John, first to you. Help us break down some of the flows you're seeing right now. Despite the big run-up in tech stocks, large-cap ETFs have surprisingly seen outflows this year. So explain why that is.
Yeah, I think there's, like, if I'm defining 2023, I see kind of three big trends. First is you've got bonds that on a per unit risk basis are attractive relative to, say, broad-based U.S. equities. Why? Front-end rates are trading very high, right? Fed has jacked up interest rates. You can clip, a T-bill and get 5%, take no risk, right? So that's troubling for stocks, let's say, in the U.S. So as a result, you've got, $82 billion of inflows into bonds. Equity ETFs have only taken in like $55 billion of inflows, right? That's a very big difference from what we're used to seeing in prior years. The second big trend that I see is this, kind of non-U.S. over U.S., right? So let's talk about U.S., right? I think the macro picture in the U.S. is a little bit murky, right? You've got this bifurcation in some of the macro data, right? Some macro data is good, some of it not so good, right? So I think the international markets are much further behind the interest rate cycle and the inflation cycle. So as a result, you tend to see a lot of flows into non-U.S. ETFs, right? So 40 billion into non-U.S. in aggregate, whereas U.S. broad base is only taken in like 14 billion. Some of these single country ETFs like EWI, EWP, EWG, right? These are single country European ETFs. They're up 15%, right? The one we use, IHDG, which is kind of broad developed international markets, is up 11%, right? The U.S. is basically, the broad-based S&P is being driven by 7 stocks, right? And we're going to talk about that with Dave with his product. But, so it's just a lot cleaner in the non-U.S. market. The final thing I would say is like this rotation out of value, into growth. And I think, we're starting to see these energy ETFs, 8 billion of outflows, broad-based tech, not a lot of inflows relative to the move, but you really got to break down tech, and you start to see the semis have taken in some inflows. But broad-based, I would say, like when I look at the Qs, which is the big institutional product that people are going to trade, in size to get risk on, risk off. It trades like water. That's taken in it's seeing about 2.5 billion of outflows. And even if I start adding in like the levered Qs and then, the mini Q, which is QM, there's just not a lot of inflows into tech on a relative basis, relative to that 30% move in the Qs year to date. So that's how I define kind of what I'm seeing on the flow front.
And Dave, what are you watching as we head into the summer? Next big catalyst, especially as the dust hopefully settles on the debt ceiling negotiations.
Yeah, no, that's a great point. I think John hit a few topics which are relevant here. I've defined this market 2023 as a haves and have-nots market. And we've seen this across sectors, across industries, and really across the globe. And the haves are companies that are really scooping up all the interest. We're obviously seeing it with AI, exposed companies versus non. We're seeing it with growth, beating value by 22% year to date. Technology sector trouncing energy. And a lot of this has to do with the interest rate environment. We were in a time with zero interest rates where a rising tide lifted all boats. You could pick a sector, you could pick a stock, and you may outperform. It didn't matter as much. Now fundamentals and the macro matters significantly. And going forward, I think this is going to only continue to be the case, which is why investors likely need to be more selective here. I think we've been fortunate that volatility has been low. Hopefully this debt ceiling is just another debacle. I think up until today, the market has really ignored it for the most part. We obviously have a vote this evening, which is going to be relevant. But usually time and time again, barring some exogenous event, we move on from it, and then markets begin to really focus on the data. And to John's point, it's been a bit mixed.